Every nation on the map carries liabilities. The United States now carries more than $38 trillion, its largest tally on record. The European Union sits near $14 trillion. Japan stands just under $9 trillion. Even states flush with oil revenues like Saudi Arabia and export champions like Germany and China maintain sizable obligations. And yet, a puzzle sits at the center of those figures. If virtually everyone owes, who, in the aggregate, is actually being paid? That is the frame for this inquiry, the point where money, power, and history intersect, and where appearances are rarely straightforward. Public debt is not only a burden to be managed, it is the framework that holds the modern system together. Every conflict, every emergency, every expansion and contraction rests on a lattice of IOUs. Trace the chain of creditors far enough, and the conclusion is unsettling but consistent. The world, in the main, owes money to itself. That, however, does not imply the gains are evenly shared. The locations of the balance sheets that receive coupon streams matter, as do tax codes, savings patterns, and demographic structures that determine who funds those streams. A society with deep capital markets can internalize much of its own debt service, while one with shallow savings must send income abroad. The headline totals look similar. The distributional footprints do not. In 1694, England was fighting France and running short of bullion. The crown turned toward merchants for rescue. In return for a perpetual stream of interest payments funded by future taxes, those merchants agreed to finance the state. To administer this compact, a new institution was formed, the Bank of England. The innovation upended prior limits. The government could now spend before it collected, advancing resources against the credibility of future revenues. Lenders in exchange received something of lasting value, a formal promise by the sovereign, documented and transferable, which could be bought, sold, and pledged. Out of that mechanism came the government bond, the kernel of the system we still inhabit. Others adopted the model, France replicated the approach, the Dutch refined it. The newly independent United States used it to pay for the revolution, and later to fund expansion westward. Over time, a reputation for honoring coupons on schedule became a strategic asset as important as fleets or forts. Creditworthiness set borrowing costs set military reach, and military reach reinforced credibility, a self-reinforcing triangle that defined modern statecraft. Move forward 3 centuries and credit has become the world's most pervasive export. The United States lists $38 trillion in federal obligations. Japan exceeds $9 trillion. Global borrowing adds roughly another $1 trillion worth of claims every 100 days. Everywhere you look, there are issuers and buyers. Each country owes, each bank lends. Each citizen, via taxes, savings, and pensions, is positioned on both sides of the line as debtor and creditor. Still, a practical question remains. Who holds the other end of the cable? Consider the United States because its liabilities spill far beyond its borders. Of the $38 trillion total, roughly half sits as debt held by the public owed to investors rather than to other government accounts. Of that public portion, about 2/3 is held domestically by American banks, pension systems, mutual funds, insurers, and the Federal Reserve. The remaining third, around $9 trillion, rests with foreign owners. The identity of those holders influences currency flows, hedging demand, and the sensitivity of funding costs to global shocks. When domestic savings absorb issuance, exchange rate pressure is milder. When foreign flows dominate, geopolitics can spill into auctions and basis spreads. Japan is the largest with about $1 trillion, followed by China near $800 billion, then the United Kingdom, Luxembourg, and Belgium. So, when it is said that America owes China, the statement is correct, but only to the tune of something like 2% of the total figure. Most of what Washington owes is owed inside the American system. The Treasury issues securities. Private institutions and funds purchase them. The central bank at times buys them in turn, expanding the money stock. Taxes collected from Americans fund the coupon payments, which flow back into American retirement and savings vehicles. The debt is concrete, but the creditor is largely a reflection in the mirror. This internal loop also buffers shocks. When risk aversion rises, domestic institutions often rotate toward treasuries, lowering yields even as issuance continues. Conversely, if domestic demand weakens, the Treasury can extend tenor or adjust auction sizes to sustain depth. The plumbing is engineered to make rolling routine. This loop is not uniquely American. It is planetary. Japan channels savings into US Treasuries. The United States channels support into Europe through institutions like the IMF. Europe extends credit to developing states via the World Bank. Developing states direct their own foreign exchange reserves into the bonds of advanced economies. What emerges is a global relay of obligations, a pass the parcel in which the parcel is a stack of promises. Each sovereign holds pieces of others' paper. Each promise leans against another promise. It resembles a poker table where everyone has borrowed chips from a neighbor, and the shared understanding that keeps play orderly is that no one abruptly rises and walks away. The structure multiplies resilience in calm periods, yet it also transmits stress quickly when any major node falters. Liquidity, in other words, is a network property. Confidence anywhere supports confidence everywhere, and the reverse is equally true. Beneath that sovereign layer sits another one, the markets themselves, which are ultimately decisive. Behind each bond stands a mesh of institutions, hedge funds, pensions, sovereign wealth pools, commercial banks, and central banks managing portfolios measured in tens of trillions. These actors, taken together, set the price of time and risk. They determine which issuers tap money at low cost and which must pay dearly to refinance. When their confidence fades, currencies tumble, cabinets fall, and entire economies are remapped within weeks. Elections choose leaders, markets ration survival, and presiding over this architecture is the central bank, the modern system's market maker of last resort. Its communication calendars, collateral frameworks, and standing facilities shape term premia and liquidity conditions across the curve. A tweak to eligibility rules or haircuts can redirect rivers of funding. A sentence in a press conference can shift global asset allocation. Central banks do not merely supervise government finance. They fabricate the medium that makes it possible. When the Federal Reserve or the European Central Bank buys public securities, it manufactures new money and swaps it for bonds. The liability booked on one balance sheet becomes the asset on another. Put differently, each dollar in circulation corresponds to some claim in debt form elsewhere. Debt-free money is not part of this design. Every coin, bill, and ledger entry carries an invisible IOU. The loop holds because participants believe that interest will be paid reliably, even if principal is never retired in full. As long as that belief endures, the mechanism stays in motion. Reserve creation in this sense is the lubrication that lets the gears turn without seizing, withdraw liquidity too abruptly, and refinancing costs jump. Provide it recklessly, and inflation answers. The craft lies in calibrating support, so that confidence is maintained without unmooring prices. We have seen what occurs when belief thins. In Greece in 2010, the sovereign's obligations slid beyond what the economy could service. Holders of Greek bonds took fright. Yields soared. The European Central Bank and the IMF intervened. But the price of relief was austerity, higher taxes, reduced spending, and joblessness on a mass scale. For a generation, bailout acquired a second meaning: sacrifice. Argentina's repeated failures to meet its promises turned the debt cycle into a national burden. Sri Lanka, running out of foreign currency with which to honor external claims, fell into shortages and political turmoil. When the structure breaks, the previously faceless creditors step into the light. International agencies, rating firms, dispersed bondholders whose collective stance can tighten a noose. And still, after each fracture, the logic restarts. Fresh loans replace old ones. Old terms are renegotiated. A familiar balance sheet resumes under a revised heading. The pattern reflects a core reality. Sovereign insolvency rarely ends the game. It reshuffles claims and resets timelines, while the need for collateral and safe assets remains. The reason is straightforward. In this era, sovereign obligations are not engineered for retirement, they are designed to roll. Governments do not intend to zero out the stock. That is not a secret scheme. It is the policy blueprint. Households take loans expecting to repay principal, States treat borrowing like a subscription that renews issuing new claims to redeem maturing ones, a cycle economists label refinancing. In that world, interest is the product sold, the rent charged for stability, and the world economy depends on that rent. A shark must swim to breathe. A system built on rolling claims must keep refinancing to function. The key metrics, therefore, are service cost as a share of revenue, the average maturity that defines rollover risk, and the investor base that anchors demand. Manage those levers well, and high debt stocks can coexist with stability. Neglect them, and even modest stocks can become crises. The United States will not extinguish $38 trillion. It will shift and extend it. Japan has been extending obligations for decades, with a tally above 250% of national output, and yet yields on its bonds remain near zero. Investors are not waiting for closure. They are waiting to renew. Why? Because for them, government paper is the safest collateral available. A US Treasury note is not perceived as a problem to be disposed of. It is treated as a core asset. Pensions hold it. Banks post it against other exposures. Central banks treat it as near money. The entire financial framework assumes that sovereign debt persists, because if it disappeared, the system would lose its most trusted anchor. Repo markets, derivatives margining, and global payment systems depend on a deep pool of risk-free collateral. Drain that pool and transaction chains snap, not because cash vanishes, but because the high-quality claims that grease intermediation become scarce. Imagine Washington attempting to pay every last dollar it owes. Balance sheets worldwide would be stripped of their most stable holdings, because treasuries sit at the core of collateral chains that support repo funding, derivatives margining, and the day-to-day liquidity of banks, brokers, and money funds. Remove that collateral, and the gears that let institutions borrow overnight, hedge duration, and price risk would grind. The supply of dollars would crater as the Fed's assets shrank and private portfolios lost their safest instruments, pushing the system toward deflation and shock via collapsing money multipliers, forced deleveraging, and fire sale dynamics. In wiping out the debt stock, policymakers would erase the very foundation that enables markets to clear term structures would be distorted, reference curves would vanish, and prudential rules that treat sovereign paper as high-quality liquid assets would become impossible to meet. So governments follow the opposite rhythm. They continue to issue not aimlessly, but in a cadence that markets can digest staggering maturities, smoothing auction sizes, and coordinating with primary dealers and central banks to maintain depth. The flow of bonds becomes, in effect, capitalism's pulse, moving through pensions, mortgages, and trading books everywhere as benchmark yields shape discount rates, credit spreads, and mortgage coupons. That is why campaign lines about balancing the budget or paying down the national debt function as slogans rather than operating instructions. The practical aim is not elimination. It is to keep obligations sustainable, appealing enough for buyers to hold, affordable enough for taxpayers to service, and stable enough in tenor that refinancing remains routine in fair weather and in storms. Sustainability is technique, terming out maturities to limit rollover risk, broadening the buyer base to reduce concentration, anchoring inflation so real yields remain predictable, publishing transparent calendars to reduce surprise, and using liability management operations and buybacks to smooth kinks in the curve and protect market functioning. When belief weakens, arithmetic stops cushioning the landing, confidence cracks, bid-ask spreads widen, and policy rates transmit into term premia faster than models assume. Yields surge, and a system built on rolling commitments begins to seize as refinancing windows narrow and haircuts rise. The plain truth of public finance is simple. The plan was never wholesale repayment. The plan is to preserve belief that payments will keep arriving on time and in money that holds value. As long as that loop of trust remains intact, the numbers can stretch well beyond intuition because coupon streams keep clearing, collateral keeps circulating, and maturity ladders keep rolling. But trust is not evenly distributed. Saying, "we owe it to ourselves," describes a netting identity, not lived experience. Interest does not flow uniformly through society. It moves upward and inward out of paychecks and tax receipts toward the institutions and investors who hold the claims, where coupons are compounded and recycled into additional asset purchases. In this sense, debt is not merely a transfer across borders. It is a transfer across strata, shaped by who owns duration, who bears tax incidence, and who can hedge inflation. That is one reason rising indebtedness and widening inequality often appear together. Pensioners and savers with assets benefit from coupons and price support when central banks backstop liquidity. Workers without assets shoulder the taxes, inflation adjustments, and tighter credit conditions that finance and discipline the system. The same macro mechanism that stabilizes demand deficits in recessions, bond issuance to absorb savings, gluts can, at the micro level, widen gaps through asset price channels, indexation rules, and access to financial intermediation. That is one reason. Rising indebtedness and widening inequality often appear together. The system tends to reward those positioned to own claims households with retirement accounts, institutions with long-duration mandates, jurisdictions with deep savings, and penalize those whose role is to fund them through payrolls and consumption taxes. The pattern scales, from households to nations to the globe. Surpluses accumulate where balance sheets are thick. Liabilities concentrate where safety assets are demanded. This does not require villains or saints. Creditors and debtors are two sides of one engine that transforms future income into present spending. The complication arrives when the engine loses fuel, when new borrowing cannot keep pace with obligations written years before, and nominal growth or inflation cannot soften the load. At that moment, the abstract "who is the creditor" stops being an academic question and becomes a personal one, as specific funds, agencies, and foreign reserve managers are named. People hunt for a single face to blame, a capital city, a financial district, an institution. But the truth at the top is diffuse. It is not just one foreign treasury. It is not just one set of bankers. It is not just one multilateral office. It is all of them. And it is also us, because the modern order has fused money and debt so completely that they are difficult to separate. The IOUs that settle our daily transactions are the same instruments that sit in retirement accounts and central bank vaults. The same bond can be cash-equivalent collateral in one ledger and a liability in another. Ownership and obligation are mirror images, swapping places depending on which balance sheet you read and which side of the trade you occupy. Governments issue the claims through treasuries and debt management offices. Banks multiply them through fractional lending and securitization, turning sovereign paper into the backing for deposits and credit. Investors exchange them as prior generations exchanged metal, using benchmark curves to price everything from utilities to unicorns. Citizens hold them for retirement and rely on them for security via pensions, money market funds, and insurance reserves. The border between owing and owning has been smudged by the very tools collateral frameworks, repo markets, quantitative operations that keep the system upright. Once, the word debt conjured a chain and a creditor's key. Today it points to balance, a mesh of offsetting entries that, if maintained, allow economies to reach scale by synchronizing savers' need for safe assets with borrowers' need for funding. But balance is conditional. If confidence fails, because inflation escapes its corridor, institutions fumble communications, or fiscal paths lose credibility. The gloss peels away, and what remains is the essence of every IOU, a promise that cannot stretch indefinitely without adjustment, devaluation, or restructuring. That is the hinge on which this story turns. If the account above has reframed the system you inhabit, consider staying for the next chapter. History already stores the answers. How past regimes managed rollover stress with maturity extensions, how they restored anchors after inflation scares, how reserve shifts were handled without rupturing trade. The same records that show how prior orders resecured credibility can guide choices now. The architecture is familiar. Outcomes depend on execution-credible fiscal rules, independent but accountable central banks, transparent debt management, and institutions capable of acting fast when liquidity, not solvency, is the problem.